Hey everyone, it's Joshua here with another edition of Mortgage Clarity, the YouTube channel that tries to add some clarity on what it means when we talk about different loan programs, different interest rates, and how much money do you need down. So if you're looking at buying or refinancing a house, this channel is for you. Today we're going to talk about interest rates. What causes interest rates to move? A lot of confusion here. Some people think, they'll call me and say, hey, what's the interest rate today? As if there's only one rate, which there's not. There's lots of rates. So it's not just as cut and dry as, hey, I want the lowest rate. You're really trying to figure out, I want the lowest cost of having this loan for as long as I plan to have it. So a lot goes into that. So again, today we're going to focus in on what makes rates move. Now, a very common misconception is the Fed's fund rate. And the reason this is very commonly misunderstood is because the way the news reports on it all the time. They'll sit there and say, oh, Feds are raising rates, as if that means all rates go up because the Feds did something. And I'm going to show you a chart here that can kind of show you that that's not the case, because the Feds typically only raise, if they're going to raise rates, they do that about every 6 weeks or so when they have their meeting. So it's not a daily thing. And as I will show you, rates change not only daily, but a lot of times throughout the day, rates will change. So what's going on there? Now, the Fed's fund rate, again, that's a special rate in which the Feds are lending banks for overnight. So it's very, very short-term lending. But it does have an impact on what happens with the market. What you may not know is in a normal market, if nothing else is going on, when the Feds raise the Fed's fund rate, you can actually see mortgage rates go lower. It's not that it's going to happen every time, but frequently you would see that go lower, or the reverse would be true. So we're going to first dive into what kind of rates look like. So you can kind of see from a lender's perspective what we're doing here, because again, I mentioned that there's multiple interest rates out there in the market. And so what we do is we try to track one specific rate that's kind of in the market. So based on where the market's going, we will change from time to time what rate we track. But what you're looking at here is what's called the yield of the given rate, or the profitability. So this is how much the market's willing to pay. So when you see things go up, what that's telling you is the market's willing to pay more for that rate than they were before. Or here you can see we had a steep decline here. And so that means the market's no longer willing to pay as much money for that given rate. So what does that mean to you, the consumer? Well, what that means is, again, there's lots of rates here, is that if the market is not willing to pay what it once was, then the consumer has to pay more for that rate. This is commonly referred to as a discount fee. So maybe you started out, you're looking at a certain rate, and let's just say that cost was zero, what we call a par rate. So you're not paying anything for it, but you're also not getting a credit from the market for it either. It's par. Well, as the market changes, and we'll talk about what might cause this to happen, then you would see that, okay, this got eroded. So now maybe to keep that same rate, you have to pay 1% discount fee to keep that rate, because the market's no longer willing to pay it. Or if you're like, hey, I don't want to pay that fee, then you take a higher rate now to get back to where par was. So this is what we talk about. So so that's really what's happening. And you can see that these things change throughout the day here. And so based on these changes, like here in the morning, rates were at one point, but by the end of the day, the investors probably repriced their rate sheets. And so if a consumer wasn't locked in, they might see that at the end of the day, they paid more, or if it goes in your favor, you actually pay less. Okay, so that's kind of what a rate looks like. So what would cause these things to change? Well, there are lots of things that can do that. But in general, what we have is 30-year fixed rate mortgages. It's an investment tool that people, of course, purchase what's called mortgage-backed securities to hold. That's in competition with other short-term instruments like, the 10-year treasury is a very close comparison. The reason we like to track those two is because even though you have a 30-year loan or 20-year loan, whatever it might be, vast majority of people don't keep those much more than 9 years. So looking at a 30-year or a 15-year or whatever compared to a 10-year is pretty comparable, apples to apples, for timeline. Now, the 10-year, which is an instrument issued by the government, has the backing of the government that, we assume that we'll never default on it. So it has low risk, and therefore it has a lower rate of return on it. But because of that low risk, they're willing to take that. The flip side of that is you could take a little bit more risk and buy mortgage-backed securities, which means you have the risk of defaulting. People may not, a certain percentage of your portfolio may not end up paying, and so you have, you lose some money there. So there is risk to what's going on in the housing market. But because of that risk, you usually get a higher rate of return. So where am I going with all this here? Well, these two instruments, because timeline, they're there, they tend to trade together. So if you start to see the 10-year get too high or too low, then the risk trade-off for the other instrument starts to kind of weigh into it, to where if this got too high, in order for the market to sell mortgages, they got to get back up above it. Or if the 10-year going on, all kinds of stuff going on here, drives that down, well, now it's so low that, we don't want to, invest maybe in that 10-year at 3% when the rates are at 7%. Now it's worth going for the rates. And that movement of money back and forth based on these spreads can actually pull these into line. So as money leaves the 10-year bond market because of the attractiveness of the mortgage-backed securities, supply and demand, all that money is moving over here. And that supply demand starts to pull that back in line. So you kind of get a correlation between these two. So that's one reason. Now, the other big things that we look at is things like inflation. Really, inflation is the number one key driver on what's going on in the rates. There's all kinds of news data that can come in and cause short-term movements and stuff. But really, what we've seen here, and this video is filmed here in 2023, we just saw all these interest rates come off these record lows and just jump radically. That was tied to inflation. I mean, think about it. If you're going to lend your money out, and say back in 2021, you're lending your money at 3% was what a mortgage-backed security was going for. Well, if inflation's run at 2%, 1.5%, you're still making money. But as inflation goes from, less than 3% to where we saw inflation go over 6-7%, now you're losing money. Even though when you get paid back, you have more in your banking account, the buying power of that money is much, much less. So inflation, we kind of say, is kind of the cancer of a mortgage-backed security, because you've lent your money for a fixed rate for long term. And if inflation passes the rate in which you lent the money out, you now lose. So as we see inflation heat up, we see rates go up. As we see inflation come down, you typically see rates come down. Now, another thing that can influence this, of course, regardless of inflation, which is what we saw in 2022 or 21, was even though we saw really high inflation, interest rates stayed really low. Well, why was that? Well, because the federal government can manipulate. It's not the Fed's fund rate, but what they were doing was they were going out, printing money, and buying billions and billions of dollars of mortgage-backed securities. So with all that demand being brought on by the government, just scooping up everything, that caused rates to drop. And when inflation went up, rates stayed low because the government just didn't care, and they kept buying. Eventually, when inflation got to the point and the government realized, it's too much, they stopped buying, and you saw rates shoot right back up because they went to where they need to be, because the market in general is not going to be willing to buy a mortgage-backed security, your rate at 6%. If inflation is running at 7%, they're not going to do it. So that's the two main things that we'd see there. Again, very simplified version here of what drives rates, but the important takeaway from this video is Fed's fund rate is not your interest rate. So just because you hear the Feds are going to raise or lower, don't think that's going to directly impact the mortgage rates like you think it will. More key we want to look at is what's going on with inflation in the market, what's going on with the spread between the 10-year and the 30 years, what's that spread doing, and then is the federal government going to step in and manipulate the market or back out of the market. So also, I think just the last little caveat is this is a global world, so it's not always just about what's going on in the U.S. market. You also have to look at what's going on globally, because investors and stuff, while the U.S. is a very desirable market, there's other opportunities in Europe as well to buy those securities. So what they're doing over there can have an impact what's happening here as well. So I hope you liked this video. It was a bit long, a bit technical, but it gives you a clearer idea to understand what causes rates to move, why rates might change intraday. So if you're working with somebody and think my lender just called me up and now my rate's different, you guys, the lender's being honest with you, there's nothing weird going on. The market changes throughout the day, all the time, constantly. So hope you liked this video. If you did, thumbs up, like it, you have comments, put those down below. I'll respond to those as I see them. All right, till next time, have a great day.